Everybody, welcome to the TraderMerlin Show for your weekend edition. It is Friday, the 24th of March. Good to see you, Margaret. We got future trader Doc C from Kansas. Sorry, I didn't mean to create a disturbing image for you. I know when people in Kansas see that kind of picture, they're like, uh-oh, tornado coming? Anyway, good to have you with us today, Doc C. We got Daryl, Options, Merchant, Skilled Stocksman, Thomasina Glenn, and I'm sure many others that just haven't typed in hello yet. So, what a week. What a fun one. Let me talk about the graphic real quick before I get into kind of the trading week wrap-up, talk about trades, and a bunch of listener questions that came through. The graphic today, I wanted something that it felt honestly like today was kind of a calm before this, not a calm before the storm, but the eye of the storm, if you will. If you look back the last 5 trading sessions, we've had a lot of volatility. And while today was rather volatile from a range perspective, we really didn't have much of a price change in our market. So it kind of feels like that's that moment, the eye of the storm. So I told Mid-Journey, I said, give me an eye of the storm over New York City. I want financial numbers swirling around. Unfortunately, it didn't give me the numbers I thought would give me in the eyeball there, but there you go. Hey, good to see you, Gary, and Mark, and Tom. Everybody's with us today. So that's what I want to start with, is kind of this lull in the action. There was a lot of speculation today with what was going on in the banking sector. Of course, a lot of the financial stocks continuing their volatility, continuing their slide. And a lot of that had to do with an announcement that Janet Yellen was doing a closed-door meeting, no press, nobody allowed in there, and all of a sudden people started freaking out that the Treasury was going to come out and do something dramatic, which they didn't. Anyway, let me raise a glass here. We were going with Bibb & Tucker 12-year bourbon today, or 6 or 12. I forget which one it is. Either way, it's pretty damn good. Thank you, my good friend Carrie, for sending me a bottle of Bibb & Tucker. That was awesome. Oh, yeah. Hoorah! Get that weekend started right. All right, let me go to the charts and just work our way backwards from the bottom to the top. Crypto, I could probably do a show here in the future, which I have not done recently. I know I went on a little bit of a rant yesterday about crypto and the very clear attack that's being done on the crypto world by our elected officials, by our, the Treasury, the FDIC, Federal Reserve. They're all going after crypto, and it is what it is. The question is, how do we deal with it, and what should our protection for our accounts be? Either way, Bitcoin had a little bit of a weak day today, down 2.9%, as you can see here. Almost, you could call this a bearish Harami formation, which is you have a really nice uptrend, and then you have a small candle that fits within the previous day. So the exact opposite of an engulfing formation. Today we had a, sorry, my throat, got something stuck in there today. I think the whiskey would clear that bad boy out, but it didn't. This is a classic example of a bearish Harami. Unfortunately, the only negative part about this bearish Harami on Bitcoin is it should be higher up today. It should be higher up on the curve, if you will, to really be a powerful one. But it could certainly lead to more downside movement based off that. And for those who are in the crypto space, you have Do Kwon, who's the guy behind Terra Luna, which collapsed and lost about $60 billion worth of money. And he was arrested. They have video of him being dragged away in handcuffs. That was awesome to see. Sweatpants and handcuffs. Yes, I did put Wall Street in here, Mark. I actually did type in Wall Street into the graphic to get that New York City feel, but I think it's a pretty... I actually have a whole bunch more. You guys, you always seem to like when I go through some of the other graphics, so let me real quickly show you the other 4. These are the other contenders that I had for the graphic for today. I had that one, which I really like this one. It's just kind of had this really evil... let me see real quick. There you go. It really had this kind of evil look to it, but not really an eye of the storm, just kind of just an overall evil picture. Let's see what it was. This one was more of an eyeball. That's one we used today. I have this bad boy here, which really is cool. I think this one's probably the coolest one. It didn't work with the label on the top and bottom for the show. And then finally, I had that bad boy, which, a clear look at what Manhattan might be. Kind of weird, the building toppling over here. But anyway, you gotta love the AI, the Chat GPT, all the fun stuff that we can do with these graphics, make it even more enjoyable. So anyway, shared the alternatives that I had for my program with you guys today. Did you ever do yourself? I have done myself. Yes, I have. It didn't really do a good job. Of course, I'm going to be very critical about myself, right? No matter what, it's going to do a bad job. But I have done myself quite a few times on that one. I actually was going to do the picture itself for Monday Morning Must, or not Monday Morning Must Knows. This picture here, this was going to be an animated one, but it couldn't figure out what to do with the jacket, and all the jackets it gave me were just really weird and bizarre, and it made me look like a monster. Not that I don't look like one anyway, but yeah, I just went with the real picture there. Hey, Big Eb, good to see you, and John. So that was our worst performer out there was Bitcoin, which, you know, I'll take it. It's been a real choppy week, given all the crazy stuff, and the regulators are going. Yeah, that's true. I definitely like the sound of my voice, but I don't have to listen to my show. You guys do. Although some of you guys are crazy because you listen to the show on double speed. Man, I already talk fast enough, and now you're going to speed me up and make me sound like a chipmunk at high speed? That's crazy. Anyway, look at the 5 days here for Bitcoin. You know, we gapped up from this is the futures, by the way. So we gapped up coming into the week and a little bit higher jump there, and then just a lot of sideways chop. Given all of the horrible news with Gary Gensler going after Coinbase, going after Do Kwon, and now hoping getting him extradited, going after Justin Sun and Tron and BitTorrent and Lindsay Lohan and all these different celebrities wrapped up in crypto, plus the Ripple lawsuit and shutting down ACH exchanges for things like Kraken. You would think that crypto would absolutely be imploding right now. What's happening is, I think by cracking down on it, it's making people want crypto more because you just don't trust that banking system. At least that's the perspective I see on it. All right, let's move up the ladder. Crude oil coming back from some much deeper losses. Only was down 1% on the day. Was much, much lower, but finishing at $69.24, down 1.03%. I'll get to that question in just a second, T. Gold. I actually didn't even look at this one at the end of the day. I'm pretty sure my silver will be taken away from me, but let me see here just a second. Gold down 0.72%. So it's funny, I saw these numbers. I'm like, sweet, if gold's down, that means silver is down a little bit as well. But here's SLV, which closed at $21.22. I sold the $21 call options against my silver position, so I'll have to do something else with my capital that was in silver on Monday. Who knows? If we get a nice big sell-off, I might actually buy some silver at lower prices and sell some calls against it again. But silver was down 0.28% on the day, where gold was down 0.72% on the day. Going towards the podium, we got fourth place here, Dow Jones Industrial Average, long bottoming tail. Someone actually sent me a question, is that a hammer formation? No, it's not, because of location, right? It's in the sideways chop for the past 2 to 3 weeks. Not really that significant. Now, granted, it does typically mean a bullish sign here for a candle like that, but I'm really not hanging my hat on that one. Of course, going into the weekend, we have plenty of time to let these patterns pan out, and everything could change by Sunday night when the futures markets open back up. Podium time, NASDAQ, positive territory by 0.51%. You know, it's been just bouncing across this high point here, right around 13,000 on the NASDAQ 100 futures. A much better looking candle today. The reason I say that is the last 2 days we've had these long topping tails, which tells you the sellers are pushing it back down. Well, today, closing right near the high of the session, even though it's a much narrower range, kind of a compressed day here for the NASDAQ. So all in all, pretty decent day. Started off higher, gave back a little bit of those gains, and then closing right near the highs for the future. So good showing for the NASDAQ 100 and still challenging those highs. Now, S&P 500 is a much different picture. It did have that long bottoming tail as well and trying to move back up, but for the week, really just a lot of sideways chop on it, finishing up 0.58% on the day. And the leader, which has been one of the weaker ones out there, is the Russell 2000. Now, notice the difference between the hammer formation on the Russell, which you see right here, and the hammer formation we have on the Dow. The Dow is in the middle of this sideways range, whereas the Russell is down near the bottom of it, and the tail today actually made new lows. So this one I actually like a bit more. Of course, I'm not trading tomorrow because the markets ain't open. But when Sunday night opens up, we'll see how the Russell futures stack up. That is obviously a bullish formation to have this down near the bottom of a downtrend, and because it's at the lower end of that with new lows, I put a lot more weight on this hammer formation versus that Dow formation that we see. The same picture of trading activity for the day, just much lower on the curve. All right, so that is that. Let me real quickly get to the question that came through here, and I'm going to need another sip of whiskey. Why? Because it's Friday, and I can. John says, sold some SLV 20 puts today. Good. Right on. I will probably be selling some on Monday. You know, collect that 1% premium. We'll find out what the premium is going to be like on Monday when the markets open up for me, but I'll probably sell and look to get at least 1% for maybe the month. I'll try to go shorter term than that if I can. All right, let's see. T. Cruz says, Merlin, Are we slowly marching towards stagflation? Inflation is still stubborn, and now there's cracks in the financial systems, an increase of economic slowdown. I think that there's always going to be that risk. Again, for those who might not know, stagflation is really represented by three components. Component number one is high inflation. Check that box. Component number two is slowing growth. Check that box, right? The previous GDP number we had for the quarter over quarter was 0.6%, which is decent, but now the expectations are we're going to come out at 0.4. So there is a slowdown going on with GDP. So you have GDP slowly declining. You have inflation, which is declining, but still relatively high. Those are two components that say, okay, this is potentially stagflation. The one that's not budging at all yet, Cruz, which is really critical, is the unemployment number, right? We have unemployment rate, I forgot, I think I want to say 3.6 or 3.7, somewhere in that ballpark. That is still incredibly low. So right now, we can't say stagflation because you don't have high unemployment. That's that third variable that's necessary. Could we get there? We certainly could, and that's something that Bill Addis has been talking about on this program. He says, I asked him, I said, Bill, what scares you right now? And keep in mind, love Bill Addis. He's been trading bonds for 45 or 48 years? I mean, he's been in bond markets a long time. And I said, Bill, what scares you? And in the past, he said, not much scares me. I've pretty much seen it all. In the last year, he's been like, the thing that scares me the most is stagflation. He goes, that's one of those situations that is so hard to get out of because once you try to fix one problem, you totally screw up another one. For example, if you try to fight inflation by raising interest rates, as the Fed has done, that starts to choke off capital. And by doing that, the economy slows down, GDP continues to slide. That leads to layoffs. Layoffs lead to unemployment numbers. Unemployment numbers lead to fewer people spending, and all of a sudden we start that vicious cycle. So what is the Fed going to do to try to help unemployment if it gets really high? Well, you lower interest rates, which puts us right back in an inflationary environment. So it's like they really have to balance out these things gently. And the way that we raise, I say we, like I had some hand in this. The way that the Fed raised in the last 12 months is jaw-dropping. I mean, that is such a parabolic move up. I personally don't believe we've still seen the impact of a lot of these rate increases hitting the bottom line economy. So I think a lot of surprises to come for the rest of the year. Could we get stagflation, Cruz? We could, but until unemployment numbers start to jump up, I'm not worried about it at all, right? The Fed has said, and I've mentioned this many times on the Monday Morning Must-Knows I do for Online Trading Academy. I mentioned it here. You know, if unemployment stays low, the Fed still can do a lot. They can still, pump money into the economy. They can still keep raising rates, because that'll fight inflation. It might hurt GDP, but ultimately what you're going to look for from them is unemployment going to start to surge? If it does, and I see a comment here from Rajesh says, unemployment rate has to be 6%. Well, I'm not quite sure if you mean that it has to be like currently it is 6%, if you look at the U6 rate. But I think what you're saying there, Rajesh, is if it gets to 6%, then you start to think we have a high unemployment rate and looking at stagflation. Well, historically, going back to the 1940s, the unemployment rate historical average is 5.7%. So even if we got to 6, would you really call that a high unemployment number? I don't know. I think the politicians would make a big scene about it because certainly there'd be people who are unemployed and laid off, and that obviously hurts an economy. Anyway, great question, Cruz. I think that you can't tell me no, Rajesh. You got to spell it out because I don't know what we're saying no to. I say a lot of things here, so no to what? Before unemployment goes up, watch for help wanted signs to disappear. Good point. I mean, we are at full employment. Down with, again, anything under 5.5% is full employment. Ben Bernanke was back in 2008 saying it's all about getting back to full employment when we had our super high unemployment rate. And 5.5% was the target. And remember, we got to 5.5, and then it was 5, and then it was 4.5, and he's still going, no, it's okay. We're going to keep being aggressive. It's like, you met your objective. You're supposed to stop lowering rates. Did you say the third quarter will start to fall? I didn't say that, but I do believe that. Remember at the beginning of the year when we did our January special show forecasting the market? Hold on, whiskey just called my name. When we did our January show forecasting where we think the markets are going to go, I love it because we have so many people that watch this program, so many different opinions about where the markets are going to go, and it doesn't matter what pick you made. It's all about having an idea where you think things are going to go and building your plan around that. And my plan was I felt like we were going to have a pretty positive first quarter. I thought things would slow down in the second quarter, just not as strong. Still, I think still slightly up in Q2, and then Q3 and Q4 is where I think the economic data will start to sour because of these rate hikes, which should start impacting near the tail end of the year. And then I think we'll probably have a weaker Q3, Q4. Is it going to be apocalyptic? Right? Is it going to be like what was it, Siraji, the guy who said Bitcoin's going to be $1 million within 90 days? I don't think that's going to happen. But could we still see further pain in the financial sector? Absolutely. And if that gets much, much worse, then these markets could have a big sell-off. But, if you look at the bell curve of probability, I think the probability is high that we have a negative year this year for the equity markets, just because of all this, the things that are being done from the government level, contraction, raising rates, and things like that. That should have an impact for the negative. So I kind of said for the year, I think we're going to be unchanged, just pretty much flat for the year because of January, February's gains, and then the declines we see at the tail end of the year. Anyway, what do we got? Tom says the financial manipulation should be stopped. Yep, there should be legislation to remove hindrance and the producers of goods and services. More goods equals lower inflation. Yeah, and this is the problem. I've mentioned to you guys before that I interviewed a guy from the Bureau of Labor Statistics, and he says they cook the data. He says they manipulate the data, and I could not believe it when it came out of his mouth, but he says depending on the political agenda, they'll modify the components, they'll tweak things to fit a political agenda. So when you look at the data, just remember it's most likely manipulated. I don't trust it either, and I think that was Rajesh's point there with unemployment being 6%. That's unemployment is about 4.2. They have out of here. Yeah, but if you look here, I mean, the real metric, and we can all look at some report that says it, but let's go U3 rate. If you look at the Bureau of Labor Statistics, here's the one that puts out the data. This is the important one. Oops. Let me real quick go back to U3. Employment rate. Should be BLS. I don't want the Fred. What I want is the Bureau of Labor Statistics. Bring that one up here. This is the one. Yeah, so here is the U3, which they say right now we're at 3.6%. Most people that I know look at the U6, which is 6.8%. So there you go. All right. Yeah, I'm with you, Rajesh. Hey, I told you about the Balaji guy. I don't think it's going to be $1 million, but if it is, I'm going to be real happy because I got some Bitcoin right here that would be really happy to be $1 million a coin. Anyway, let me continue on here. So again, love the questions. Keep them coming. Let's see. For today, I'll run through just a couple more charts, and then I want to go to these listener questions, make sure I get through them all while I'm still sober. I'm kidding. I'm not drinking that much, but here's your dollar index. Remember yesterday we talked about at the end of the day how it had a beautiful hammer formation. Great hammer formation at the end of an aggressive sell-off here on the Dixie, and said, hey, real good possibility that you're going to see a little bit of a move up here on the dollar index. We got some nice follow-through. Dollar rallied today. Of course, that's what put pressure on these equity indexes early on. But the market's kind of shrugged off a lot of that data. There was some good economic news that came through with regards to economic data with the services manufacturing numbers. It was painted a decent picture for the U.S. Other than that, you had bond yields continuing to slide. Now, I mentioned, I think it's going to come to this 3.25 mark, 3.25. Right now, we're at 3.38 on that 10-year. The logical stopping point should be somewhere right around 3.25, but if this trend continues, this should bode well for the housing market, which we're already seeing better numbers in existing home sales. And I think I didn't check the new home sales numbers, but this should really help out the housing market. It's funny because as this has been falling over the past month or so, I've seen a bunch more houses pop up in my neighborhood because, people can now afford money because the 30-year fixed rate mortgage is dropping. Great, let's do it. All right, let me go into a few listener questions. I have quite a few today. Robert says, what will happen to Activision's options if Microsoft acquires it? My research says that they will cease to exist. I have got 400 shares of Activision and have sold some January 2025 95 strike calls against it for over $3. If all goes according to plan, this June, Microsoft buys Activision for $95. And I get to keep the options premium. And when the options disappear, it seems too good to be true, but open interest at that strike. Not so concerned about the open interest. So what will happen there is if Activision gets acquired by Microsoft, then all options will disappear for Activision on the day that purchase is finalized. And whatever the strike price is. So you sold the 95 calls. If on that day, Activision close at $95, 96 bucks, well, your shares would be taken away from you at 95. If they close at 94, you keep all the premium, options expire worthless, and your shares would disappear again at the purchase price. If that's what they said 95 bucks. Whatever the purchase price is, your shares will disappear at roughly that price. So they're pretty simple one. If they're in the money, your shares would disappear. If they're out of the money, keep all that premium. Great, right? So now, I mean, if you know they're buying them 95, and I don't know this, I haven't followed the Activision piece, but let's go ATVI. All right, you see the big jump up here to 85. If you know that the purchase price is 95 bucks, then by all means, go out there and sell tons of calls. Sell as many calls over 95 as possible, because most likely it's not going to go over 95 on the deal. So all of them will expire worthless. So if you can get any money for the 100s right now, sell them. Go for it. Right? If it expires out of the money, those options expire worthless. You keep all the premium. Yep. Not too good to be true. It's just part of the way that these things work. Let's see. A couple good questions here. All right, I'll read this one here from Chase. Chase says, option volatility is off the charts on NVIDIA and shorts have been getting decimated. I was wondering what you thought when it gapped up early and ran into supply. It looks like it closed within the previous day's candle. Patience is the key on the name like NVIDIA. I do feel like it's getting due for a pullback. Tomorrow's another candle. So let me bring up NVDA for everybody out here. I'll be brutally honest with you, Chase. When it gapped up, that's all I thought was, okay, it gapped up. It's not going to be a trade for me. I really don't think anything more than that. I don't want to. I don't want to, overthink it. If the trade didn't happen, and I think what you're referencing is this. When we go back to here, try to zoom in. Just we have, we had the shooting star on Wednesday, and I was like, great. If we open up in that yellow area, sell off below it, I'll be happy to go short. But because it gapped up here, I just said, nope, not going to deal with it. Actually, I wasn't even up at the open. I was sleeping in. But when I finally got up and looked at it, it was still hovering here. I didn't do anything. Now, if over the course of that day, it ended up breaking lower and then broke during the day, okay, fine. So I had an alert set, but it never met that alert, and it was a no trade for me. I definitely don't overthink it. I can always, as a trader, I could always focus on these things and be like, oh, it's got to do this, or I'm going to do this. I don't care. I got too many other things to do. I don't want to focus on NVIDIA. If I really felt strongly that shooting star was actually going to come to fruition over the course of that trading day, set the alert like I did. And then if it breaks down below it, I can real quickly log in, check it out, look at it. And if I want to make the trade, then I will. But I'm not the type that likes to sit in front of my screen all day trading anymore. That used to be fun for me. I loved sitting in front of my screen back in the late 90s and just absorbing all that information. Now I've got this thing outside called sunshine, which I'd much rather enjoy that and go live my life and have fun. But that's it. I know you probably wanted more of a real deep dive into how you trade it. I don't. Just look away and find something else that was appealing. Rajesh says, bank melt-up is inevitable if interest rates are not going down by a year. It's hard for me to say inevitable, right? You look at the financials, and certainly I think there are some that are going to have a nice move up. A melt-up, I'm not going to call it a melt-up, right? Could there be a bounce in financials? Yes. A melt-up, right? In my mind, Rajesh, when you say melt-up, what I'm thinking of is a parabolic move that just screams to the upside. I just don't see that, right? Let's real quickly look at XLF, run through a couple other financials here. So here's your XLF financials, right? Even if it got back up to 37, I wouldn't call that a melt up, right? That's only a 20% move to the upside from current levels. So a melt up to me would be a candle that looks like this. Let me just draw it. So it's just so I, perception and terminology. A melt up would be something like that, where the financial markets just not only bottomed, but ripped, just screamed through highs and did so in a very short period of time. Personally, I don't think that's going to happen. Now, I hope that you're right, Rajesh, because I'm long JP Morgan, I'm long Bank of America, and I just sold some puts today on another one, which we'll talk about here in just a second for Jeff. But I'm anticipating that this will start to slow down, right? We'll see this aggressive sell-off slow down. Maybe XLF does continue to go lower here a little bit, but I think the main pain is already priced in, and we're past the heavy sell-off. Now, I could be wrong. We might see Jenny Yellen come out and say, hey, we're seriously unstable. Oh, you mean a melt down? You wrote melt up. Yeah, you wrote melt up. Yeah, I don't know. I don't think we're going to see a meltdown. I think you're going to see some banks continue to slide. I think some of the other ones will do well. And then again, that's just a real risky play. By the way, anybody who's trading options right now, you know, you're probably the biggest premium you're going to get right now is trading bank stocks. I mean, the volatility is insane. The premium is great, but the risk is also super high, which now brings me to the next question, which is from Jeff. No problem, Rajesh. No problem at all. Jeff says, with so many financials being down, I ended up selling a put contract on a bunch of different stocks for two reasons. Number one, the credit received was pretty good. Number two, I wouldn't mind owning a stock at such a great discount. I think the price would have to bounce 50 to 75% of where it was in the next 12 to 18 months, if not sooner. So before I read the second part of that, I love what you wrote right there. You said the credit that you received is pretty good. So you've already determined that the reward for you was good enough to sell those puts, right? That should be number one. Is the reward worth the risk? Number two, you said you wouldn't mind owning some of these stocks at such a great discount, and rightfully so. I mean, normally if I'm trading an ETF, I have no problem making that statement and saying, yep, I'd like to own these at these discount levels. You have to be extremely careful though with bank stocks right now, because even though they look great, even though we might think great things about these banks, they could still get smoked if this financial contagion does spread. Now, I think that most of the heavy stuff is already behind us, especially when you have billions and billions of dollars being brought back into the financial system. When you look at what the Fed has done, they spent the last year unwinding their balance sheet, right? And I have a chart here somewhere. Unfortunately, I think I may actually have it on my phone. Let me see real quickly if I can bring up this chart for you. It was a great chart. But they spent the last year unwinding their balance sheet, right? Which is what they need to be doing. Get some of the balance that they have removed from their balance sheet. Get some money supply and remove it from money for circulation. Well, what happened, let me see if I have it right here. No, that's a debt to GDP ratio. Anyway, I'll have to find it for another show, but I have a really cool chart on this one. What they've done in the last 2 weeks is 50% of all the money that they removed from circulation in the past year has now been put back in, just to show you that how desperate they are to make sure this isn't spreading and becoming contagion. So kind of a weird thing. You spend a year just removing money supply, liquidating their portfolio a little bit so it doesn't impact the market too much, sell it, and then all of a sudden financial crisis hits or banking crisis hits, and you flood the market with money again. Gee, all that work to remove money supply to fight inflation might be backfiring because of these bank situations. So we're probably going to see inflation start to tick back up because of all the money being poured in right now, but we might have a stable financial system for it, and that's some of the play that I'm making. Still don't understand the Schwab downtrend. Liz says, too bad there's no options on SGIM. I'd love to sell puts on. Yeah, right? SGIM's great. Quantitative easing, quantitative tightening going on at the same time. Yeah, well, there was quantitative easing and quantitative tightening, and now massive quantitative easing. All right, let me go to this question here, the last part of it, and I'll show you the chart of First Republic. He says, what are your thoughts? FRC was paying over $20 at a $10 strike until next week. What is the risk with this? So what I'm going to do is I'm going to ask you guys to tell me what the risk is here. I also took this trade, which is kind of funny. You sent that in. I had sold earlier in the day. I didn't get 20% rate of return. I actually got 19% rate of return. So I sold for $1.90. But if you look at this chart here, right, I'm going to put a line where I sold at, the strike. So I basically sold the $10 strikes expiring next Friday. And I will explain that one to you here in just a second. Style coordinates. Let's go here and make it 10. Okay, so the $10 is where I sold that put. In reality, my average break-even price, because I collected $1.90 in premium, since I sold the 10s, my average is going to be $8.10. That's my average price, right? And if you're not with me, let me know. So I'm going to zoom in here, and just so we can kind of get that into perspective, let's zoom in a little bit more, right? And it seems like it's highly plausible it could get there, right? These are really close to current levels, but let's just zoom in here so we can get into perspective. The level that I sold my puts at is right now, it would have to fall 19% by next Friday, which it could absolutely do, right? So what's the risk here? What's the risk to Jeff and I? Remember, we sold the $10 puts, which means we are committed to buy it at 10 bucks. It's currently trading at $12.36. So it actually have to fall, over 20% to get down to 10 bucks. Not over 20%, 19%. Have to fall 19% by Friday. 7 days away. Could it do it? Absolutely. Absolutely. But again, my average price would be 34% lower. Could that happen? Yes, it could. Now, I'm going to read here real quick, but you guys keep typing. What do you think is the biggest risk to Jeff and I? Because Jeff's probably thinking, well, if I receive it at 10, how low could it go? Let me see what your answers are. Kathy sold Tesla and now bought Coin and Square. Risk is you acquire it and then it goes to zero. So that's all I've got. See, Chase says, good tweet from Dan Niles today. Expecting more bank failures ahead despite FDIC expansion. $700 billion troubled asset relief program passed in 2008, and bank failures rose to 140. Yep. So again, I don't think we're done. But here's the risk to this one. This is the same thing that happened with Silicon Valley Bank. And this was, a unique situation, a black swan, if you will. The risk is not necessarily zero, but if something happens next week, and let's say, even though First Republic got $30 billion worth of funding from JP Morgan, Bank of America, and they have the backing of the FDIC, and all of that right now is saying, hey, we're going to back you up. I'm still committing to buy at 10 bucks. So what happens if the same thing happened to Silvergate, Silicon Valley Bank, and Signature? Remember, those banks were just frozen and stuck, right? So let's see if I can bring up SIVB here real quick so you can see what happened. And I'll tell you the max problem here, the problem. So here you guys can see 106. So this is Silicon Valley Bank, which basically is done trading at $106.04. If I sold the $80 puts, right? Let's say I sold those $80 puts to somebody, just because Rajesh is here, I'll say I sold it to Rajesh. So if I sell it to Rajesh, and he bought my $80 put, that means that he has the right to unload his shares to me at $80. So the problem here is this stock is done. It's done. It's zero. So Rajesh has the right to sell it to me at $80. He bought that put from me. I sold it to him. So now Rajesh can go, market's frozen. This thing's going to go to zero. I am now on the hook, and he can put those shares to me at $80 a share. That's the big risk. So as someone who sells puts or calls, you are there's obligation there. Now, some brokerage firms won't allow you to exercise your options when everything is frozen. And this is kind of a strategic thing as well. I need to do a little bit more research here and find out the firms that won't allow you to exercise if something has been halted. But in the case of First Republic, FRC, right? Basically, I am now putting $10 worth of risk per share. I collected $1.90, so I basically have $8.10 worth of risk. So the max loss to me is actually $8.10 per share. If for some reason next week FRC gets halted by Friday and frozen, and they say it's going into a receivership, and the FDIC takes over, I'm screwed, right? So Jeff, you got an insane amount of premium. You got 20% for a week, dude. That is awesome. I mean, that's hard to beat. But you got to ask yourself, why did you get such high premium? And that's part of the risk I took as well. You got a couple percentage point more than me. I only got $1.90, which is on the $10 strike, is a 19% rate of return for 7 days. With the amount I bought, I'm okay with that, right? I'm fine taking that kind of risk because I don't think they'll get halted by next week. But I do agree. I think Chase here, brings up, I don't know who Dan Niles is, but there is a high probability that banking stocks are still going to feel some pressure, even though they have the full backstop from the government. You and me, diamond hands. Well, I mean, in this one, I'm taking a chance. I'm taking a huge chance. In most of my portfolio, I play it very conservative, but I've got certain accounts where I'm allowed to take big chances. And this, with First Republic, that's a big chance. I mean, that is a big chance, but I'm okay doing that with that amount of reward for it, right? I don't think it's going to go to zero. And that's what you call manipulation and tricking you into holding the bag. I'm kidding. No, not you. Don't say you're kidding, Oliver. You can lure people in with amazing rates of return. And that is an amazing rate of, I think everybody here would agree that 20% rate of return for 7 days, I mean, that's nothing to shake a stick at. Most people aren't going to make that in a year. But the one thing that I did not do, and I'm pretty sure that reading Jeff's email here that he didn't do either, is I didn't go all in on this one, right? This is a small bet of my portfolio, fine. The other stuff is going to be much safer. I would rather go and sell puts on XLF because I've got 67 companies in that ETF to spread around that risk. Trading First Republic that's a dangerous thing, man. I mean, this is one that was on the brink of bankruptcy and going under. So you got to always keep that in mind. Tom says, buy cheap puts below the put you sold to limit that loss. It's called a spread. Damn you, Tom. Yeah, I don't worry about limiting the risk. I'm fine with all the risk. I want all the reward. I'm being greedy there. It is, Big Eb. It's about risk and reward, but also, segmenting my accounts and knowing this account I can do that, this account I can't, right? You guys know I always like talking about my 1% account. In that account, I can't do this. I can't make this trade. It's way too risky, right? I don't want to take that kind of risk in that account. However, the account that this trade is currently in, the risk account, go for it. Take your shots, right? And, in that account over the years, I have big swings in that account, whereas the 1% account is a much more steady line. And when I do have drawdowns, they're very, very small. The risk account, obviously, is going to have a much bigger volatility. And there you go. Jeff, he did on 8 different stocks. Great. Spread that around. I'm pretty sure, though, you did them all in banking stocks, which is still rather risky. Big Eb asked, what on earth is going on with Charles Schwab? I don't know exactly why Charles Schwab is drifting lower. My guess is just caught up in the malaise that is, the whole financial meltdown or banking meltdown right now. That most likely is just what's causing this thing to get swept up. I don't see Charles Schwab being this kind of subprime lender or venture capitalist lender or crypto on-ramp or anything like that. So I think that they're going to be relatively safe, but you just never know. Unless you're looking at the financials and you know everything about them, there's always that uncertainty. And as they say, that rising tide floats all boats. Well, right now the tide is absolutely going out on financials, and I think a lot of companies are going to get swept up in that. I mean, JP Morgan, for example, is making some good acquisitions, and look at the price, just been drifting lower and lower and lower. So, next week, I will have to, right now, I have to sell my puts. Oh, actually, my puts are for next Friday. I have sold some calls on JP Morgan against a position I have that I was put to at 132, and then I also have Bank of America, which has been drifting lower as well. My strike price was 28, but I've been collecting premium on that, so I don't know exactly what my average price is at this point. But I agree with you, Chase. I think Schwab is solid as well, but you just don't know. People said that WorldCom was solid back then too, and Enron. Oh, great company, great. Look at the fundamentals. Look at the number. It's great. You just don't know. Now, I personally agree with you. I'm playing devil's advocate here, Chase. I do think that Charles Schwab is sound. However, the kiss of death right now for Charles Schwab would be if Jim Cramer came on TV and said, Charles Schwab is fine. Do not sell Charles Schwab. If that happens, then Big Eb, you got to unload your Charles Schwab and get rid of it. Bank of America is sitting on more losses than JP Morgan. Yes, they are, but they're also very diversified, which is one of the main reasons I wanted to go into Bank of America and JP Morgan is the business is very segmented into many different areas. So if one area does poorly, you have other areas to offset that, plus a lot more retail and smaller fish than somebody like First Republic, which is a much bigger bank. Yep, it is. It's a thrill. It's a thrill a minute. It's a roller coaster, that's for sure. That's pretty damn scary. Let me see. No, don't sell. Don't panic. No big deal. Let's see. Michael, you asked this one, and this is not I don't really focus on this too much, but it says, what does it mean when people say max pain about an option? I saw a chart that showed max pain for Tesla options this week is 190. What exactly is max pain? And is it true that market makers really try hard to get the stock price to line up exactly with the max pain number? Yes, I would actually agree that they are looking to get that max pain number to line up. And essentially what it is, it's where a majority of the options are going to expire worthless, right? Obviously, the market maker that you're buying options from, they're selling those things and they're hedging. They're going to have to balance their books out and figure out how to accommodate for all the options they just sold you. So that max pain number, you can actually go to, there's a website out there that's pretty good called Max Pain. Actually, did I delete it? Here it is. You look at something like Tesla. So they'll string up and show you all the different the value of the options at different strike prices, and max pain would be that lowest point here where the most number would expire worthless. These are all ones that would expire in the money or they expire in the money, but worthless right now would be 190. And you can type in all kinds of different values here or different symbols. So for example, let's have fun. Let's go First Republic. Let's really freak everybody out. See if this actually comes up. That was weird. First Republic, and we'll go. There we go. So we'll go down to First Republic, and I'll go to their max pain. Right, their max pain right now for the options expired today. We'll have to do this again next week to see. Is 1650. That's where most of the options that were bought and sold are going to expire worthless. Somewhere in this 1650, 17 mark, you can see the values there, and it gives you all the puts and calls. So that's typically what max pain means. And you could look at it as a magnet for price. I'll have to review what this looks like next week to see how that might line up for the puts that Jeff and I sold. Let's see. August Texan, you think they might address the bank regulations that were taken away during Trump era? Yes. August, I can't say anything's 100%, but I would say you got a 99% chance that they're going to revisit that and say, listen, we removed pieces of Dodd-Frank that said regional banks or banks with under $250 billion worth of assets don't get as much oversight because we don't want to pay for all these regulators to go and check. We're trying to cut costs, which I appreciate that approach. There's certain areas where you might not want to cut costs. And we hear so much about systemic risk, right? Oh, this is a systemic risk. Well, when you have a business that's $250 billion worth, I would argue that that's a systemic risk. Now, if it was a $250 billion e-commerce company, I'm not so concerned about that. That's not a systemic risk to me. But a $250 billion bank, which is taking money and making loans and using consumer deposits, to me, that is a systemic risk. So I definitely think that you're going to see the arguments come back, say, hey, we need regulation. Those components of Dodd-Frank, which were removed under the Trump administration, they'll probably get put back in for specific reasons like this. And the best part about it is you're not going to hear any regulator or politician say, yeah, we caused this. It was our fault. They'd be like, oh, yeah, no, we looked, everything was fine. Everything was fine. The banks were fine. Yeah, no, they weren't fine. There were some problems out there. Tom says, believe it's not market makers that care about moving to a price. It's institutional traders, hedge funds, etc. Market makers just need to be neutral. Exactly, neutral, correct. Not necessarily at the end of the day, but they need their portfolio to be neutral. Otherwise, they take way too much risk. So I believe that that market maker, which could be a variety of different people, is going to use that option market and try to move price so that max pain number benefits them, meaning they don't have to pay out. The least amount of losses to them, and everything expires worthless. So all those buyers of puts or calls expire worthless. Great, let them expire worthless. And I believe that there's manipulation to that. So the max pain number, I do think is important because if for example, we go to the max pain, let's go back to what we had for, what was this, Tesla. Let's say that all of a sudden Tesla has a huge rally and jumps up to 230. Well, there's a lot of money here at this 230 strike where some market maker is going to be out a lot, right? They're going to have to do something to hedge their position on these call positions. That's a lot of loss. So they'll push things. They have a lot of power and influence to move these markets in their favor. We can't. You and I are too small to move it. But somebody like a Goldman Sachs or JP Morgan or these big institutional heavy hitters, they can collude, right? Institutions like let's say you have Goldman Sachs and Morgan Stanley. There might be a perception that they hate each other. Oh, I hate those guys over at Morgan. Bottom line is they're like, there's a quid pro quo, you scratch my back, I'll scratch your type of environment, that if there's a certain pain point for Goldman and they reach out to somebody like Morgan Stanley and say, hey, we're underwater on these Tesla puts, right, or Tesla options, let's bring it back down to that 190 number. And the guys are like, dude, it's a 230 right now. We'll just start selling or issue a negative press release. It would really help us out. That type of stuff goes on behind the scenes, and I think that the SEC for many years has said that they try to stop that. They're going to stop that stuff. When I sat on the floor, I was on a trading floor for a company called Southwest Securities back in the 90s. And I was invited there because I was a really heavy trader. I did a lot of volume, so they knew my name from my name on the screen. It was just a number. And so they invited us down there. We went to the trading floor, and I said, do you guys collude? Do you talk to other market makers? And the guy says, he goes, absolutely not. because the SEC, all of our phone conversations are recorded. So if there's anything shady, there's always that risk we could get busted. And the assistant who was sitting next to the trader that I was sitting with, he goes, yeah, but we use Yahoo Messenger. I'm like, are you kidding me? Because the SEC wasn't watching Yahoo Messenger, and on the bottom right-hand corner of his screen, he had a little chat box, and he's out there talking to his other market makers like, hey, I just got 50,000 shares of this one. Let's take this thing down or up. There is collusion that goes on between these firms to help each other out. So it would not surprise me to see market influence and manipulation to push things towards that max pain number so that one specific institution doesn't lose their shirt. All right, there we go. And I think I'm going to start wrapping things up. I'm almost done with a glass of whiskey. Let me run through here and make sure. I have one last question. Lisa, are you here? I know you do your session for OTA today, but I thought I might show you this one. This is for Lisa, who's going to Japan. Domo arigato. Lisa says, I was wondering if you had any suggestions as to where or how to exchange USD to yen. I went to the bank, Chase, gave me wrong info on the phone, and no exchange took place. And other banks are offering 120 while it is trading at 130, plus some fees. Chase had given me a quote of 130 at the time of the call earlier in the week. So here's what I generally do. I know this is a completely off-topic thing, but you know what? It's the weekend. Let's have some fun. If you're going to Japan or Thailand or Europe, you don't need to go with any of their currency yet, right? So what I would do typically is I will go with a bunch of $100 bills. I keep those $100 bills on me. So let's say you have, $500 or $1,000, whatever. When you get to the airport, generally the airports are one of the worst places to go. But you could use the ATM at the airport, but now you're going to pay a horrible conversion fee. Plus, you're going to get a really bad exchange rate, fees on top of it. So you have bad fees and bad exchange rate. So just take a $100 bill, go to the window there and exchange $100, get your yen at that point. What I usually do is I'll go down into town and then I'll go to one of the big banks there and go into the bank and do it. Now, a lot of times they'll look to charge you a fee. Sometimes you can find money changers that'll say no fees. What I don't do is I don't change it all at once, especially if I'm in a city for a while. I might try out one or two different places and see who gives me the best deal. So I'll take my $100 here and let's say I get 100,000 yen at this place, but the other place gives me 105,000 yen. Okay, well, I'm going back to 105,000 yen and I'll cash out more of my money that way. So that's how I would do it. Just take a little bit there when you get there, convert it at the airport. It's easy to do. If there's nothing open, because maybe you arrive at a really weird time, then use the ATM and just take $100 worth out, and that's enough to get you into city so you can get situated. One place you should not change is hotels. Hotels generally are just as bad as airports, if not worse. So they always try to entice you. Yeah, use ours. We'll change it for you. No, go to a bank or use one of the cash vendors on the street. But you can always shop around. Just ask them. You'll see in the sign, it says there's a buy and a sell number, right? So each exchange place will have their spread. You can just go and it says, all right, if it gives me 100 here or 105 at the other one sounds better, but they might charge you a bigger fee. There you go. Does using a credit card overseas get a good exchange rate? No. Typically, credit cards don't get a great exchange rate. And by the way, if you are going overseas, make sure you tell your credit card, because sometimes if you don't tell them, your credit card won't work. So it's always a good idea to tell your credit card, hey, I'm going to Japan for the next 2 weeks. They have a note on your file, and therefore they'll open up your credit card, because some credit cards will literally stop you, and you're like, oh crap, I'm trying to buy something. It's like, decline. Oh no, that's not a good sign. So good to do. Do you eat those huge ice cubes when you're done drinking your whiskey? No, usually by this show, it ends, and today's the kind of day I think I might actually go have another glass of whiskey today. I just had one of those weeks. It just felt like it's a gorgeous day. I'm going to probably sit in the backyard with the dog for a little bit, and maybe I'll take a roadie over the dog park, and I don't know. What else do I have in here? I had a question above regarding FedWatch tool interest rates and Powell's projection. So I didn't see the question list, but what I typically use, I don't look at the FedWatch anymore. As you guys know, I bring up the FOMC futures site, which is right here. If you want, I can actually bring up the tickers or put the link in the chat for you, but I think you actually have that. If you go here, you want to know what December of 2023, is that what you said? Yeah, December 31st meeting. So we'll go here to, there's the December 13th meeting. So right now, these are the expectations. And you can go and look over here. There's all kinds of different documentation. So there's the current charts for rates. You can look historical. You can look at the dot plot to give you a forecast. But if you look at the December meeting, right, currently we're at 5%. Hold up. Whoa. Wow, did you guys see that? So December 23rd, or December 2023, This is how many meetings we have? We have 1, 2, 3, 4, 5, 6 meetings away. Right now, the expectation is we are going to be 1% lower on the Fed funds futures. 1%. So markets are pricing in some significant cuts at this point, which I did not know. I didn't think that was going to happen. But wow, kind of crazy. If you go 1 month ago, they were actually thinking we're going to have a 50 basis point increase again by the end of the year. That has completely changed because of this banking crisis, and now it actually looks like most are expecting significant cuts. Let's see what happened at the May 3rd meeting. Because remember, this was high probability that we're going to have a pause. Yeah, right now it looks like an 80% chance that they're going to keep rates just the same. There you go. So that's what I look at, Liz. If you have a specific question about the FedWatch tool, just retype it back in. Using credit card, let's see, got that one. I had a friend whose older brother, a bank teller, no less, wanted to convert his California money to New York money. Oh, it's Canadian money. I'm hoping you're saying Canada, because California and New York don't have a different currency. Is your dog park your designated driver? Or my dog a designated driver? No. There's no saddle on my beast. All right, yes, that's just, wow, being the most likely. But Powell said at the press conference this week he's expecting 50. Yeah. It's a great question. That's a great question, Liz, because Jerome Powell said, I'll copy it and put it in the chat for you, PBJ. Hold on one sec. Here you go. It's a FedWatch tool. It's an awesome site. I literally look at this thing every day. Jerome Powell said the expectations at the meeting, I have it written down right here. He said by the end of this year, the Fed funds rate would be 5.1%. Forecasting the end of 2024 would be 4.3%. And in 2025 would be at 3.1%. Those are the numbers he said at the meeting. However, I think the market's already anticipating and forecasting more pain ahead, which, if we don't suffer the pain, could actually be good for this market, right? You might see things really rally up. But yeah, that's kind of an abrupt change and definitely flies in the face of everything Jerome Powell talked about. So the odds of us staying right now where we're at they're not even on the chart. That's crazy. Not even on the chart. That is really bizarre to me. And that's shifted here really in the past, past 30 days has changed dramatically. It was California money. Oh, wow. That's pretty funny, Dave. Yeah, I wouldn't let him live it down either. All right, you guys, there's really nothing cooking for Monday. It's really a boring day, so no real major economic announcements. There's nothing on the earnings front. Actually, is there on earnings front? There is... oh man, I can't remember. There's a couple of companies coming out Monday with earnings, but they're not really like major names that you would, be market movers. I think the bigger names happen on Tuesday of next week, but I will bring these up here just so I can tell you who the companies are. There's 259 companies reporting on Monday, and Carnival Cruise Line. That's pretty much it. You'll notice next week a lot of foreign companies, right? A lot of Japanese companies reporting, and I generally don't report those on the show just because, I don't really trade those types of companies. I'm trading the more liquid, common, U.S.-based companies. A lot of foreign companies reporting earnings this week, and that's pretty much it. So I think that's going to do it. Liz says, so that is a full 100 basis point difference between what Powell said and what the market's pricing in. My question to you was, what are your comments about that? I find it rather odd. I think it's basically the market saying that they don't believe Jerome Powell. I don't think that he's going to cut that aggressively. I don't think that he's going to cut a full 1 point, 100 basis points by the end of the year. I don't think that's going to happen. I think that if anything, the Fed pauses. Right, the Fed would normally pause for two. You guys see the impact here. What's the damage that could happen if you raise super aggressively and then you rip back down super aggressively? Now all of a sudden you don't know what the hell impact your rate cuts had or increases had. Right, that to me is a huge problem. So I personally think next meeting he'll probably pause, and for at least 2 meetings they'll pause and wait. And if things really look ugly, unemployment starts to surge, GDP continues to decline, and inflation, if inflation starts to surge again, they're going to have to keep raising rates. And given all the money the Fed has pumped in, that most likely is going to lead to inflation surging again. So I don't know. I don't see them cutting. I kind of think he's right. If anything, maybe in the fourth quarter, like maybe at the December meeting, we drop 25 basis points. So we go to 4.75. But I do not see them going a full 100 basis points. To me, that would just be kind of crazy. And it would be kind of stupid, It's kind of like changing. How many times have I told you guys this? If you're making a change to your trading plan, you don't change a whole bunch of things at once, right? Because you need to see the impact of those changes. So you change one thing, you try that for a while and see how does this impact the bottom line results. That analogy is perfectly applicable to what the Fed is doing. The Fed's been raising, and I mean aggressively. So what they have to do is they have to stop and say, okay, hold on a second. Let's see what these rate increases have done. Because trading, it's easy. I'm just looking at my numbers. From an economy perspective, I got to see how are these numbers, these raises impacting unemployment, inflation, construction, home sale. There's so many variables to all of a sudden adjust course so rapidly. I agree with Big Ed here. It says it would be an admission that they screwed up again. Totally agree. So it would not surprise me. Let's just go out here and see how many meetings we have left. It would not surprise me at all to see at the May 3rd meeting and the June 14th meeting that they just pause and don't do anything. If you look here, you have 4 meetings after that, maybe depending on what the data looks like. And again, I am forecasting that the tail end of the year starts to see some declines. Then maybe they do start to pull back a little bit, but I just can't see 100 basis points between now and then. 100 points would be way too aggressive. And to me, really would be admitting guilt. Not admitting guilt, but like you said, admit that they kind of screwed up. That would really be just dramatic. And at that point, you've thrown out all of the research to understand how these rate cuts, rate increases have impacted the market. You lose all of that data because now you don't know what's impacting what. It's a lost cause. So I think it would be really stupid on their part to do that. Chase says, don't listen to the bond market. Well, you do want to listen to the bond market. It's all opinions. It's all opinions, Chase. I could be completely wrong. They might cut 400 basis points by December. Who knows? Anyway. All right. Are you accumulating Ethereum for long term or just Bitcoin? I have enough Ethereum. I have a lot of Ethereum. So what I'm doing now is I'm going to be moving my Ethereum off of the exchanges. And what I was actually thinking might be a good series of videos to kind of as accompaniment for TraderMerlin. I was thinking about, my buddy mentioned it last night. He goes, what are you doing with your crypto? If they're closing off the exchanges off ramps, what are you doing with the crypto? And I thought about doing a small series of 3 or 4 videos that just shows here's what you should do and how to do it through examples. I thought that might actually be something fun for most of the viewers out there. And who knows, maybe for some of you who are in crypto might be good. So I'm just accumulating Bitcoin and I will continue to, I'm actually going to bump my thing up. As I mentioned, I set it up for my class as just $10 to show recurring payments, but I'll probably bump that one up here to 100 at least and continue to buy forever Bitcoin, $100 at a time. Why not? No big deal. All right, guys, that's going to do it for me. Hope you have a fantastic weekend. Do something fun. Hopefully it'll be a nice warm weekend for us, specifically here in Southern California, which has been just unbelievably rainy. And for the rest of you around the world, I know we've got a lot of people from all over the place. Again, I hope you have a fantastic weekend. Do something fun, spread some love, be good, and I will see you guys on Monday. Take care, everybody.